Welcome back into Wave 3 Listens Live. I'm Michael Vanover, joined by a familiar face to the program. Marcus Warren is joining me. Marcus, welcome into the show.
How you doing?
Good, doing great, man. Good to see you.
Thanks.
We've been wanting to do this. You know, I'm kind of jealous. John always gets to have these interviews, and I've been wanting to do this, so this is good. Warren Wealth Management and Tax Services, right?
Yes.
You do it a little bit of everything. If you could, for the viewers that maybe aren't familiar with you, give a little bit of background on the company.
Yeah, so at Warren Wealth Management and Tax Planning, basically, what we do is we do investment management and asset allocation for clients. We basically manage their retirement assets. And then another part of that is we also do tax planning for them, because one of the things that is basically missing when we talk about retirement planning is the fact that taxes are going to be a big piece of retirement. And a lot of people overlook that. And so we basically wanted to merge the two, and so since I'm a tax expert or a tax enrolled agent, right, so to speak, it just seemed like a good thing to do, and that's where the value comes, is in that tax planning.
So let's talk about the tax planning for just a second. So why do you think that is something that is so overlooked? Because when you save in a 401k or you save in these different investment accounts, well, when you take that money out, you do have to pay taxes on it, right? Why is that sometimes overlooked by other people?
A good question. I think it's because you're worried about so many other things. Okay. When you transition into retirement, you're thinking about income. You're thinking about when to claim Social Security. You're thinking about Medicare. You're thinking about do you have too much risk in your portfolio? And taxes a lot of times takes a back seat, and people really realize taxes should take the front seat right when they have to write that check to Uncle Sam.
Right. That's right. Something you need to be thinking about, and that's what you do at Warren Wealth. Right. All right. So Marcus, we're going to talk about something today that's interesting. Okay. And that is annuities. So let's talk about annuities. So a lot of people have heard that. Some people, that is a crazy word, right? People don't understand exactly what it means. Yeah. Let's go ahead and squash some of the myths and talk about annuity planning, especially when it comes to Warren Wealth.
Yeah. So with annuities, you're absolutely right. Annuities can be a polarizing word, and that's basically because a lot of annuities can be highly complex. A lot of times they've been missold by a lot of insurance agents and things of that nature. But really, if you can weed through, a lot of the muck that's out there, because there are a lot of annuity companies that aren't so great, but they can be a complement to somebody's retirement. And so basically there's four different types. And out of the four different types that I'm going to discuss, they all have three things in common. Number one, annuities are issued by an insurance company. They are an insurance product. Okay. Secondly, they all offer tax-deferred growth. And then last, they all can provide for income for life. All right.
And so those are big takeaways there, but that's
yes,
what they all have in common.
Yes, they all have that in common. Okay. And so, and I guess we'll start with immediate annuities. And so with an immediate annuity is when you give a lump sum of money to an insurance company, and they immediately convert that into an income stream. And that can be for life or a period certain, 20, 25 years, but you are getting what I call mailbox money. You basically have created your own personal pension, if you will. Okay. And so that's a good thing. The not so good thing is the fact that you kind of give up control. Not kind of give up control, you basically give up control. Meaning that when you give that lump sum to that insurance company and they convert it into a stream of income for life, if you happen to pass away in year 2, that money's gone, right? So that's not a big plus. And then secondly, that monthly income that you're getting, it doesn't adjust for inflation. So if you're getting $1,000 a month in 2020, you're gonna get that same $1,000 a month in 2030, and we know that $1,000 isn't gonna buy the same goods and services 10 years down the line.
So the biggest thing when you look at annuities, there are obvious reasons. You just went over some pros there, but there are cons. So it's really important that people that are watching right now that are thinking about maybe that's a fit for me, maybe it's not, to really do your homework, because they're not all the same.
No, they're not all the same at all, and that's why we're kind of trying to differentiate all the annuities that are out there. And so the next one would be a fixed annuity. And so with a fixed annuity, basically you give your money to an insurance company, and they are going to give you a fixed interest rate for a period of time, 1, 3, 5, 7 years, and at the end of that term, they give you your money back. Basically, it works like it's not this, but it works like a tax-deferred CD, right? You give your money to a bank, they give you an interest rate, and then you get it back at the end of that period. Okay. The only thing I don't like about fixed annuities right now, same reason I'm not a big fan of CDs or any bonds right now, interest rates are just so low. It's tough to get a good rate on anything that's fixed right now.
Right, there's other things you could do with it potentially.
Yes.
All right, how about variable?
Watch your mouth. I'm joking. No, the variable annuity, and the reason I say that, the variable annuity, it works like this. The variable annuity, you give your money to an insurance company, and they are going to take that money and they invest it basically in the market in mutual funds, but they call them sub-accounts, right? And so, number one, with a variable annuity, you can lose money because it's in the market. So you can lose money with a variable annuity. That's number one. Number two, they are riddled with fees. A lot of high fees. And so some of these fees can go from 3 to 5%. And we're talking about mortality and expense fees, which is basically the life insurance fee. We're talking about administrative fees, enhancement rider fees, the sub-account fees. And so these things can have fees all the way up to 5%. And so let's just use 3%, for instance. So you have an annuity and you're paying 3% annually on that annuity. So you do 10% that one year, minus the 3%, you net at 7. Not so bad, I guess. The next year, say it's down 10%. You still have to pay those 3% of fees, so in essence, you're down 13%, right? And so the next year, it's going to be tough to get back. You're going to have to do better than 13%, but you're still going to have an extra 3% to pay. And so once you have a down year or two, then it gets tough to get anything back. So variable annuities, not a big fan of, but with the high fees, with the fact that you can lose money, they're very complex, and a lot of times they're missold. You know, other than that, they're fantastic products.
I think I know where you stand on those. I think I know where you stand. All right, what about fixed indexed?
All right, so with a fixed indexed annuity, basically you give your money to an insurance company, and they are going to take that money and they are going to credit your gains based on what an index has done. So you're not actually in the market, but you're linked to the market. And the way these things are sold is it's like this. It's like this. They're like, hey, Michael, how would you like an investment that it goes up when the market goes up, but you don't go down when the market goes down? You make money when the market goes up. You don't lose anything when the market goes down. Sounds fantastic, right?
That sounds, on paper, sounds great.
Has to be a catch, right?
Right, what's the catch?
There's a couple. The first is that there's a time commitment. You're going to have to give up control of your money for a period of time, and these things can run from 5 all the way up to 20 years. So you're going to have to give up some form of liquidity. You're not going to have access to your money. If you need access within that time frame, they're going to charge you some sort of surrender charge. So that's number one. Number two is they're going to cap how much you can earn in any particular year. So to fully protect you on the downside, which it does, they're going to cap what you can make on the upside. And so if you're capped at, say, 7%.
I was going to say, give me some examples.
So you're linked to the S&P 500 index, and they're going to give you a hard cap of, say, 7%, meaning that if the S&P 500 is up 5%, you'll get 5. If it's up 7, you'll get 7. If it's up 16 like it was last year, you're capped at that 7%. But conversely, if the market is down 16%, you don't lose anything. So there's a trade-off there.
Now, you brought up giving up control, right? That's a big thing. It seems like consistent with all the annuities we're talking about. You mentioned the surrender fee. Can you talk about that a little bit? Is that a stout fee? Is that something that people are like, well, I can give up control, but if I really need it, what does that look like?
It all depends, on what specific annuity you have, and so I've seen surrender charges upwards of 15+% if you need your money in the first or second year. So that means you're going to take a big hit. You're going to be down 15% if you need to take it out. So when you're looking at investing in one of these products, you have to make sure that you have a long time horizon, and if you can understand some of those nuances about these things, then it just puts you in a better place moving forward.
So as a whole, you definitely like some of these annuities more than others. Is that fair to say? Yeah,
I would say this. In our office, since I'm a fiduciary advisor, I call myself product agnostic, right? So there's nothing that I like more or the other. Whatever helps my clients hit their goals. So bonds, stocks, annuities, so forth, or so on. However, with that said, not a fan of variable annuity. Not a fan of the
which is fine, because it sounds like you feel that doesn't do your clients as good as maybe other options, to your point.
Yes, because of those high fees.
Right, no doubt about it.
Yeah.
All right, so obviously the financial markets, Marcus, I was telling you before the show, I wanted to talk to you a little bit about this. It's been all over the place. Obviously, what happened in 2020, we're actually right about at the year anniversary of the dip. I think the bottom was like the 22nd or something like that of March. People that are trying to make sense of everything that's gone on in the last 12 months, again, obviously I'm not talking about the world. The world it's been crazy in its own right. I'm talking about from Wall Street standpoint. What are you kind of seeing? What's happened? Where we're at now? Some people are getting on the apps like Robinhood or E-Trade. They're trying to day trade. They think they're going to make money that way. What would you tell the people that are watching right now about the current environment and if they think day trading is the answer?
Number one, day trading is not the answer.
Right.
80% of people who day trade don't make any money. Right? It's like
that's a big stat.
Yeah, it's like when you go to the to Churchill Downs, the gambling boat. Whenever you're gambling and you're talking to your buddies about them being up, and they always talk about their wins.
Of course.
They never talk about their losses. It's the same thing with these Robinhood apps. You're on Robinhood, and plus, they've gamified it so much where if you're up $1.50, there's confetti on the app and it makes you feel good. Those endorphins get going and you just want to do more, and they only talk about successes and not the folks who are losing money. And what you have to understand about a lot of these day trading apps is that it's not really built for long-term investors. Now, if you have the play money, play with it, money you can afford to lose, go ahead and do that.
Treat it as gambling.
Yeah, you should. That's exactly what a lot of people are doing. Speculation, gambling, that's what it is. Now, when you ask me about the current market environment, things of that nature, I don't have a crystal ball, but I can tell you this. When you look at the stats and you look at the market being at all-time highs, when you extrapolate 7 to 10 of the tech companies from that S&P 500, so to speak, then that gives you a clearer picture on what the actual economy is doing, because the rest of those stocks and companies are either down or they're flat. And that's more reflective of what's going on in the economy.
Gotcha. Okay. Very cool. Hey, we've got a gift that we're giving away to the first 10 callers. I think they call the office, the Annuity Analyzer. Will you talk about that?
Yeah, I will, real quick. So the Annuity Analyzer, basically, a lot of people have these annuities, especially if you have variable annuities. You might not understand what you have, and you might be paying a lot more than you think you're paying. Give our office a call. The first 10 callers, we will analyze that annuity for you. Or better yet, you can go to warrenwealth.net and you can upload some of that information, that annuity review, and we'll let you know exactly what you have, how much risk, and the fees that you're paying.
Well, it sounds like something that people should do, no doubt about it. And give, again, Marcus Warren at Warren Wealth a call. Marcus, thanks so much for being here with us today.
Thanks for having me.
All right,
Appreciate
man.
it.
We'll be right back on Wave 3 Listens Live. Stay with us.